Welcome to International Finance. I hope you will enjoy this class, and I hope it'll give you a different way of looking at business. All right. Make sure you read over your syllabus and you understand all of the requirements for the course. But let's get started looking at what international finance is all about. As you probably remember from your econ classes, when we look at the economy, we have this circular flow diagram here. And as you recall, hopefully, one of the flows that you see, this outer flow here, is the flow of money, how people get paid. The inner flow is the flow of goods and services. And when we look at the domestic economy, the flow of goods and services and the flow of money need to be equal. Right? In order for the economy to be stable, we need these two to be equal. But this circular flow, the way it's drawn here, does not include the international economy. We need to add that in. And so when we do, we see that we have to extend both the flow of goods and services and the flow of money internationally. When we look at extending the flow of goods and services internationally, we tend to lump that under the topic of international economics. Some of you may have taken the international economics class here at Raritan Valley, and you notice that that looks at exactly the flow of goods and services. We look at barriers to trade, things that we could use to encourage trade, all of those things. And we also include in there quickly a discussion of exchange rates. But exchange rates and how money moves internationally actually fits into the category of this course, international finance. All right, so this semester, that is what we're going to be looking at. We're going to be looking at how money flows internationally and what, as a business person, we would need to do to ensure that money flowed properly for our business. When looking at money flowing internationally, we're looking at international financial markets. And basically, the purpose of international financial markets is simply to take money from net savers and make it available to net borrowers. Very much like the financial markets domestically. That's the purpose of a bank, to take money domestically from net savers and lend it to net borrowers. We're just taking that international step now. Now, the international financial markets also do some other things. The first is to evaluate credit risks. What is the risk of selling goods to someone in another country, especially if they're asking your company for credit? How do we look at that credit risk? But it also allows for trading of financial instruments such as stocks and bonds and currency. All of this is is necessary to allow for the flow of goods and services. Because most definitely, if you're going to sell goods to someone overseas, you most definitely want to get paid for it. And you want to get paid for it in your own currency. So the fact that as an American, I may be selling goods to the Germans, and the Germans have euros and I have dollars, and I can't spend euros in the United States, it would really be great if the Germans would pay me in dollars. Well, is it in my German customers' interest to pay me in dollars? Or would they prefer to pay me in euros? And in that case, I'm stuck with euros that I need to convert. So all of these things play into the concept of an international financial market. Let's look at a little bit of history of international businesses. Interestingly, some of the earliest international businesses were trading companies. For example, the British East India, the Dutch East India, the Portuguese East India, the French East India companies. They were all looking to go to the Far East to find spices and resources and all of that, and buy them and bring them back to their home countries. The East India Company actually is the precursor to the Raj, to the British takeover of India. The British East India Company goes in, starts as a small trading company, becomes more and more powerful, so powerful that the Indians begin to push back at them, and the British East India Company petitions London to send troops to protect the East India Company and all of their trading posts, which it eventually does, and then takes over India. So the British East India Company has somewhat of a very checkered past. In the United States, the Singer Sewing Machine Company is one of the first international businesses, truly international businesses. Started in 1851, as the name implies, as a sewing machine company, but by 1890, it controlled 90% of the sewing machine market internationally. It was just an amazing growth for that company. So international businesses have been around for quite a while, and have positive and negative connotations all around. Technically, I think all businesses are international businesses, simply because all businesses are impacted by changes that occur. For example, exchange rate changes, interest rate changes, labor costs, inflation, all of these things impact your business, whether you have a little sub shop that's only selling to your local neighborhood. You're affected by changes in prices. You're affected by inflation rates. All of these things are going to impact our businesses. So even if you're planning on setting up a business and never buying or selling internationally, you are still going to have to understand how an international business works. So let's take a look at what it means to have a global business. when we start looking at global businesses, we have to decide what the goal of the business is. And this is a similar discussion that a domestic business would have. What is your goal? What are you trying to do? And so, whether it's domestic or whether it's global, the question is, do we want to maximize our shareholder wealth? Do we want to maximize profit? Do we want to maximize corporate performance? What do we want to do with our business? And that's not an easy question. Most multinational corporations, most corporations have an issue with this idea. Since a corporation is a firm that takes on the legal identity of a person, the owners may not be the people running the company. And so, how do you run the company? How many of you heard one of these commercials for investment companies, and they talk about fiduciary responsibility? Fiduciary responsibility simply means the people running the company have an obligation to run the company in the best interest of the owners, the shareholders. And there's always that conflict between what is in the best interest of the shareholders. Is that the same thing that's the best interest of the managers, the CEOs, the CFOs? We run into an agency problem when the goals of a shareholder may be different than the goals of the people running the company. It gets harder to truly maximize shareholder wealth when you're talking about an international company, because if you have subsidiaries all over the world, does that subsidiary really have the desire to maximize the profit of the company and the shareholders that may be in another country? You're not always certain about that. Another problem is foreign managers may have a very different cultural perspective of what should be done and what is ethical and what is moral and what is in the best interest of a shareholder. So again, we're looking at different ways of seeing how a company should be run. And the third problem, which really makes it hard to deal with maximizing shareholder versus managers' desires, is the sheer size of the company. As we go international and companies get bigger and bigger and bigger, just being able to manage the company, to oversee the company, becomes harder and harder. And to take into account all of the different cultures and perspectives can become difficult. So in our next lecture, we're going to continue this, and we're going to look at theories of global business.